Have you ever really thought about where your tax money goes? I mean, not just the big picture, but the actual journey of one of your dollars. Forget about boring forms for a second. Let's reimagine this whole thing as a story, a journey that starts the second you earn a dollar, all the way to how the government figures out its piece. Let's get into it.
Oh yeah, we've all been there. Staring at the forms, the boxes, all the numbers, it can seriously feel like you need a secret decoder ring just to get started. But what if it wasn't a puzzle? What if it was more like a map, showing a clear path that every dollar takes? Well, that's exactly the map we're going to draw out together in this explainer.
So here's our game plan. First, we're going to figure out what the IRS even calls income. It's not always what you think. Then we'll get to a fork in the road, the two ways you can lower that income. After that, we'll tackle the infamous tax brackets. And finally, we'll wrap it all up with a super simple checklist for your dollar's whole journey.
Okay, let's start at the very beginning, square one. Because before we can talk about deductions or rates or any of that, we have to know, what money are we even talking about? What actually counts as income in the eyes of the IRS?
This right here is the official starting line. The IRS calls it gross income. The best way to think about it is like a giant bucket. And pretty much everything you get, cash, property, services, gets tossed into this bucket unless there's a very specific rule that says it doesn't. And trust me, it is a very big bucket.
And this is where it starts to get pretty interesting. Just how wide that net is cast. Yeah, your paycheck is in there, of course, but so is the money from your side hustle. Or get this, if you trade your services for something like company stock, that's income. Gambling winnings, royalties from land, even that new name, image, and likeness, or NIL income that college athletes can get. Yep, it all goes into that big bucket.
Okay, so we've got our big bucket of income. Now what? Well, now we get to the first big choice you have to make on this journey. It's a fork in the road, and your decision here is all about how you're going to lower the amount of income that actually gets taxed. You've got two paths to choose from.
Think of it like this. Path number one is the standard deduction. It's the simple, easy express lane. A set amount, no questions asked, and you don't need a shoebox full of receipts. Path number two is for the itemizers. This is the scenic route. It takes more work, you've got to track your expenses, but if you've got enough of them, you could end up with a much bigger deduction.
So just how much is that easy path worth? Well, for 2024, if you're single, it's $14,600. If you're married and filing together, it's double that, $29,200. So the big question you have to ask yourself is, can I beat this number? If you add up all your potential itemized deductions and the total is less than this, the standard deduction is pretty much always the way to go.
Now, if you're thinking about taking that scenic route, here's a little peek at what you might be tracking. Things like state and local taxes, property taxes are on the list, but they're capped at 10 grand a year. You've also got home mortgage interest, any money you gave to charity, and even some medical expenses. But there's a catch there. They have to be more than a certain percentage of your income.
All right, so once you've taken your income and subtracted your deductions, you get your taxable income. And now we've reached the final leg of the journey, figuring out the tax bill. This is the part that confuses almost everybody, but honestly, it's actually pretty simple once you get one single idea.
You've probably heard this term before, a progressive tax system. Here's what that really means. It does not mean your entire income gets taxed at one single rate. Nope. Instead, your income gets sliced into different pieces, and each piece gets taxed at a progressively higher rate.
I want you to picture it like climbing a staircase. Everybody, and I mean everybody, no matter how much they make, pays the lowest rate, 10%, on their first chunk of income. That's the first step. Once you've earned enough to go to the next step, only that next chunk of income gets taxed at the next rate, 12%, and so on. This is the aha moment for most people. Making more money doesn't mean your old money gets taxed more, it just means the new money at the very top is on a higher step.
So that brings us to the very top step of the staircase for 2024, 37%. You hear that number thrown around a lot, but it is so important to remember this is a marginal rate. It only, and I mean only, applies to income a person earns above a really high threshold. For a single person, that's over 600 grand. Nobody pays 37% on their whole income. It just doesn't work that way.
Phew, okay, we've done it. We've followed your dollar all the way from when it was first earned, through that fork in the road with deductions, and all the way up the tax bracket staircase. So let's zoom out and boil this whole entire trip down into one simple checklist. If you only take away one thing, make it this. It's really just 3 steps. Step 1, add it all up. All your income from everywhere goes into that one big bucket. Step 2. Pick your path. Are you taking the easy standard deduction or the more complex, itemized one? And Step 3. Climb the staircase. Apply those bracket rates to your final taxable income. That's it. That's the whole journey.
So, now that you've got the map, that puzzle might seem a little less confusing. The next time you look at your tax return, what's one thing you might see differently? Are you going to think twice about whether to itemize? Or maybe those tax brackets will finally make sense? Understanding the journey really is the best way to feel confident navigating it. Thanks for coming along on this explainer.